All right, so let's now turn our attentions back to the Australian market, and normally we'd go straight into the RBA decision, but because we got the GDP numbers for the December quarter released only in early March, I thought we needed to spend a little bit of time to paint a picture in terms of what's happening with the Australian economy and how it is slowing. So what we did learn in the Australian economy only grew by a subdued 0.2 of 1% over the December quarter. Now, this is the sign that the previous 13 interest rates are really biting. And what we're seeing here is growth in the economy. Economic activity has halved over the second half of the year compared to the first half of 2023. So 0.5 of 1% versus a 1% growth in the first half of the year. Now, looking at these numbers from the population growth point of view, what we've learned is the annual growth rate is below the record 2.6% annual increase in the population that we've seen. So this has resulted in theory in terms of 1% annual fall in GDP per capita. So the only reason why we're actually in positive GDP growth territory is population growth. That's been the only reason. So the population growth has initially supported that demand and provided a source of resilience. But now as that population growth slows, we start to see the fading effect on that in terms of the data. As those incomes become elevated, we then start to see higher income taxes and higher interest rates payments weighing down on spending, according to economists from the St. George Bank. Evan, what did you see in the GDP numbers?
So there was lots of little sort of nuggets, I think is the way to say it to you, Ben. So first and foremost, net exports. So don't forget, GDP is consumption plus government spending, private investment, and net exports. Net exports actually helped significantly more than expected. Again, probably is the China story, that the import pricing and the cost of imports were lower than forecasted, which meant that the overall net exports, so exports minus imports, was higher than expected. So that contributed slightly more than what was needed. You then also look at the consumer. The consumer is the big one. For the first time since COVID lockdowns ended, we have started to increase our savings rate. Not by much, but enough, 3.2% increase. And that is so clear that the household now is battening down the hatches to deal with 13 interest rate rises and the highest cash rate since 2012. And that is all part of that story. And again, the chart that Ben has on screen and just read out to you shows that not only are we slowing down, but there is every sign that the consumer is now foregoing things that they originally were happy to do. They're not anymore. Because again, one of the other things that stood out to me was transportation. Around international travel fell 9%, but home domestic travel or near travel, so places like Indonesia and New Zealand, that rose by about 5%. So again, for me and what Ben and I talked about all the time, behavior change is absolutely clear in the data. We have already started to change our behavior, know that things are going to get tough, know that things are going to slow down, and are already planning for that future. That's what I took from the GDP figures, is that normally they're retrospective, but there was enough data in there to show what we expect in this calendar year. And unfortunately, it's not great news.
Well, it isn't. And we talked about how inflation really restricts purchasing power or spending power as we talk about it. And the household has had 18 months of rising inflation, and that has definitely reduced that sort of spending power. So add to that, obviously, residential construction activities continues to fall fast. So it's exacerbating the housing challenges that we're also facing. So the other interesting part about what's propping up the Australian economy is effectively the federal and state government spending. So their infrastructure programs and the spending and their cost of living stimuluses that they're also putting in there to counterbalance horrible stories around price of electricity and all insurance costs and everything that's basically compounding to make it really challenging. And so and we also saw a bit of life in terms of business investment. So the business community is still, optimistic about a narrow path, and so they're continuing to keep spending. The other thing for me in the GDP numbers was that finally we did start to see some good news in labour productivity. So it did start to improve. So particularly in domestic services, that's that services inflation. That's going to be that last mile in terms of, the RBA is going to be wanting to be confident that services inflation is in check. Now, how you get that in check is obviously higher productivity helps reduce labour costs and inflationary pressures, which in turn helps reduce that services inflation. So there are a couple of green shoots in that productivity area that I did like, but it's very, very clear as you can see, the levers putting the brakes on the economy and stopping that economic flywheel is really starting to play out. So what did ultimately the RBA do? Well, we saw Governor Bullock announce that, with the RBA board, that the cash rate was to remain on hold at their second meeting this year. And so the cash rate remains at 4.35%. And really it was a logical call given we didn't get a huge amount of new data. It was very much retrospective data. So it's fair to say that each meeting does remain a live meeting. And it is interesting in terms of, some parts of the economy are quite resilient. So what did you make of their call, Evan?
Yeah, it was always going to be the same call in terms of, you can't move from what they did back in November where they did increase the interest rate from 4.1 to 4.35%. You and I discussed that last meeting that, was that necessary? They argue that it is. You and I sort of maybe slightly more on the fence on that. I think also what they're sort of still seeing is that there is still a slow lag dealing with the data. And there are, unfortunately, there are calls and caveats out there that are suggesting that there's even chances of no rate movements in 2024 at all. And some are even forecasting rates up. Now, I want to point to that one quickly because, again, the RBA is certainly, although they're saying it's a two-way street, their intention is to hold or to move down. They don't believe that an additional level of pressure would probably actually help overall. The caveat also is government spending, and we'll talk about that in a minute. But government spending is the unknown quantity here, particularly around tax cuts that we're getting, and the possibility of a May budget that could be stimulatory. So the RBA's got all of that to juggle. So right now, they're probably right. They're not going to move rates before the end of this financial year, so June. But there is a lot of other things that I think starting to creep into their thought. And we just talked about GDP. And that, for me, is the other part of this story, is that at what point does GDP contraction start to go as the front and foremost important thing over the inflation story?
It's really interesting, Evan, in the sense that, the RBA still has this tightening bias in their commentary and their language. And I think that's well founded in a sense because if everyone still thinks property prices are on the move, so there could be a wealth effect going on, that, the federal government is signalling they're going to give more cost of living stimulus. Mm-hmm. There is this, sort of small 10% chance that we could see another rate rise. Now, again, that's a 90% chance that it's not going to happen, but that's the sort of messaging. And so I think they want to be jawboning in terms of that narrative out into the marketplace because they still want people to be slowing down their spending, right? It really is going to be an important part of that story.